I think that if you don't have to buy right now and you're the incremental primary buyer, I suggest waiting. I think you'll get a better price to buy. And I think the market is too heated and not sustainable.
Thanks for joining us for part 2 of our interview with housing analyst Ivy Zelman. If you haven't yet watched part 1 of our discussion with Ivy, in which she explains the major trends driving today's housing market and why she doesn't expect many of them to be sustainable for much longer, just head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Ivy and I talk about in this video. And don't forget to support this channel by first liking this video and then clicking on the red subscribe button below, as well as that little bell icon right next to it. If everyone watching right now takes these 2 simple steps, it really does help this channel reach a lot more people. Okay, let's get started watching part 2 of our interview with Ivy Zelman. These players, which hold multiple houses, in many cases hundreds or thousands of houses in their portfolio, dumping them on the market. And we've just seen the headlines with Zillow this week where, they've got several markets where they are getting out of thousands of houses all at once. I don't think it's necessarily happening, the next day, but it looks like they're selling blocks of these houses, to another institutional investor for the most part. But, could we have sort of very sudden, surprising repricing of markets as these large players move a big chunk of their inventory at once?
Definitely possible. It's tough to say. We're in a seller's market right now. I mean, it is as strong as it's ever been. So the idea that they're going to sell homes at a loss, just my brain can't get around that. It's just obviously they way overpaid.
But that may be the sign of a late stage bull market,
to
right?
me it's sort of it's a harbinger of things to come. I mean, it's sort of recognizing how quickly things can change when it's not that primary owner or even that sticky second homeowner. These companies are in the business of turning inventory to the iBuyer. So in this case, they overpaid, and in a seller's market now they need to reduce their position because they're getting out of the iBuyer market because they basically said it's too volatile, it's too risky. And other iBuyers would say they just did a bad job. They overpaid. They didn't have the economics, lined up. So I think it does, from my perspective, signify the risks of what investors' presence actually incrementally can do to a market, both positively, and now we're seeing some of the potential risk that they're now presenting. As we think about affordability and we think about home price inflation today, there is true real demand out there right now. I don't want to paint a picture that it's under some type of pressure, or we're seeing that affordability is gone through is tanked and no one can afford to buy a home. People are buying homes. There's strong credit out there. There's people that have down payments, but a lot of them are starting to get nervous that they're either buying at the peak. So you're seeing buyers taking longer to make decisions. You're seeing less multiple bids. And you're also starting to see people that actually truly can't afford it because the monthly payment has been sequentially going up at a double-digit pace, combination of home price and mortgage rates. So by the end of 2021, we could be poised from third quarter to see monthly payments sequentially increase almost 20% at the current rate we're running. So there is primary demand, but we're really pushing right now at this intersection of rising home price inflation, risk of rising rates, to really slow down things because affordability is really starting to get stretched. We're not there yet, and there is still primary demand, but it's clouded by all of what I call this non-primary demand.
Right. You're seeing some of these storm clouds at least, begin to appear on the horizon, and, to just the affordability levels. You mentioned the specter of rising interest rates that could change the game here. You talked earlier about supply, potentially increasing dramatically or substantially in a number of these popular markets. We didn't even talk about just the slowdown in general economic growth. The country could go back into recession too. I mean, so there's just lots of potential storm clouds that could, come into the horizon as well and maybe lead to a storm at some point in time here. So Ivy, I really I've got 3 hours left of questions for you. We don't have the time. So let's try to end on a little bit of a lightning round here. And if some of these questions aren't, completely fair, I'll apologize in advance. But looking out 2 to 5 years, how worried are you about a, meaningful correction in housing prices in a material number of markets across the country, housing markets across the country? Not worried, very worried, what?
Right. Well, I don't want to make a call, anything that certainly variables can change. Our demographic outlook is very sobering. We certainly are concerned about the level of development, but if the development were to stop, so one of the best friends to the housing industry right now is the supply chain bottlenecks that are mitigating the ability to build as much supply as they'd like to. So it's a great regulator. And let's say the capital, all the announced capital, because only about 20% of it's actually been deployed, actually invested in the ground. Let's just say all that capital pulls back. It can change the dynamics of what the oversupply risk that we're outlining could come to fruition. So it's very difficult to say. I'm more cautious than optimistic based on what I see on the horizon. But there's too many pieces of the, call it the pie, to really get comfortable to make a more definitive call, which is one of the beauties of our firm. So we have the ability through C-suite owners and operators in every part of the housing ecosystem, whether it be home builders, land developers, brokers, mortgage companies, multifamily operators, single family rental operators. Every month we are aggregating from owners and operators their pulse of the market. So we check ourselves every month, and we have quarterly reports that we know what's happening, allowing our clients and our industry executives to stay ahead of the curve. So making a call 2 to 5 years from now, it can change so considerably. But if I had to say I'm more cautious than optimistic, I think that would be how I would answer.
All right, very fair. And that was sort of why I apologized before I asked the question.
No, it's okay. I can take it. Bring it on, Adam, whatever you want.
But more cautious than optimistic is helpful. And I should warn you, you seem to, given how your business is structured, really have your finger on the pulse of what's going on. You said monthly readings and quarterly reports. We just may have to have you back on quarterly, maybe even monthly at some point, to hear what you're hearing out there. Okay, almost last question. How concerned are you, or not even concerned, but what's the potential, the likely potential for changes in the tax code to impact the situation here going forward? We see repealing the SALT deduction, getting batted around in DC a lot recently. Is that something that you're closely focused on, or you don't think it's that big of a factor in the near term?
I'm admittedly a bit cynical about anything the government says they want to do with respect to tax policy, but it feels like tax policy would more likely hurt the housing market than help it, from the perspective that we're going to see higher capital gain tax, we're going to see higher overall income tax, and maybe it's more skewed to the affluent, but it could result in more pressure in markets that are high cost states and markets that have high tax bases, because those markets, whether it forces people to live multi-generational or it just disincentivizes more incremental people to come to that state. New York, for example, as much as I love it, I can never live here full time, just can't get my arms around the taxes. So
you're like me in California. I mean, everybody in our states is fleeing for Texas or Florida or whatever.
It's crazy as much as you believe that, though. When you actually look at zip code or address change requests by the post office, in 2020 in the state of California, only 0.3% of California's population actually left the state. So it's definitely something happening, but not to the masses. Your friends are probably very affluent. People that can leave are leaving, but it's still a relatively small number. And I think that small number will continue to likely drive more people to migrate out. But I don't know. It's not going to be the majority.
Okay. Good clarification. Thanks. All right. And then just sort of in wrapping up here, Wealthion is watched by people who are trying to basically protect and build their wealth, right? We have a very uncertain future environment, both in the financial markets and, as you've just done a great job here enumerating, in the housing market, right? There's a lot of unknowns. There's a lot of reasons to be cautious, just as you said you are. Do you have any sort of parting advice for people, whether they're a homeowner or a prospective home buyer, things that they should be keeping in mind as they either think about the housing that they own or think about the housing that they want to buy going forward?
I guess a few thoughts to think about, personally, how I'd position myself is that if I have a second home that I'm really not using and it costs a lot of money and I'm just not getting, the time to really utilize with my family, great time to sell right now. Great time to sell. Take advantage of it, whether it's primary or a second home. Right now, it is a seller's market and you will realize a significant return. And the people that actually stay put and the equity that they've accumulated, it's a nice piggy bank to have. They have a tremendous amount of equity, whether we see equity compress depending on the market. I think that there's a lot of opportunity just to have more safety with the equity that you've earned. So it's the incremental buyer we worry about, but those that are in the home right now as a primary resident, they definitely have more wealth creation because of all the equity they have built. And that's one of the better aspects of this cycle than prior cycles is that, today the equity in the United States is, 98%. You got 35% of Americans that actually don't even have a mortgage, which has been predominantly the case, but a lot more equity than we had historically. If I'm investing, I'm trying to diversify away from just being long real estate and trying to look for alternatives to the stock market as well. So whether that's investing in alternatives within fixed income, trying to just make sure I don't have all my eggs in one basket. And my advice to consumers is if you're thinking about buying and you're not in a rush, realtors joke there's the 3Ds of real estate because you'll in a recession, any economy, bad or good, you're going to always have transactions. But in a recession, you still have the 3Ds, which Adam, I don't know if you know the 3Ds. So I'll just tell you, you've got death, divorce, and default. And in good economies, you have a discretionary D and a diaper D, which is that buyer who needs more space because they're children. So I think that if you don't have to buy right now and you're the incremental primary buyer, I suggest waiting. I think you'll get a better price to buy. And I think the market is too heated and not sustainable. So I feel bad for the incremental buyer right now. I would wait if I can. Now, if you can't wait because you've got, you're busting at the seams and you've got 3 kids and 1 on the way and you need more space, you got to move, you got to live somewhere. But I do think that there's patience will be a virtue in this situation.
Okay, great. So time is on your side for those who can afford to wait here. All right. And in closing, you, I believe, have a new book that's come out relatively recently. Can you tell us a little bit about that?
Sure. Thanks for asking. Actually, it's a memoir. It's called Gimme Shelter. And after my favorite band, Rolling Stones, I wanted to have shelter or something to do with housing in the name. So I really wanted to tell a story that would inspire and pay it forward to people that are interested in pursuing a career on Wall Street. I didn't come from a traditional background. I put myself through undergrad, going to night school and working as a secretary and really getting a job on Wall Street, first at Sullivan Brothers and then later Credit Suisse and being a housing analyst. So I really tell a lot about sort of my life trajectory and how I intertwine my family, being a mother and still working and, as they say, trying to have it all, have your cake too, and how to navigate stories along the way. So hopefully, as I said, it's inspiring. And many people that have read it have said, made me think about my own career and the things that I've gone through. And so I've had some really fun conversations with people that have enjoyed it. So it's been a fun project. Took me a few years, but I got it done.
Well, I got to say, look, having started my career on Wall Street for a brief couple of years, knowing that you went through Salomon Brothers mortgage division, I mean, that's like going through, front line of the Marines, if you're serving in the military. so, just the fact that you made it through that, it speaks an awful lot. And of course, you've had a, storied career after all that. Where can people who are interested in taking a look at that book get it? On Amazon?
Oh, it's Amazon, Barnes and Nobles, and it's available, I believe, in a few other places, but I'm not sure. I have to ask him.
No worries. Okay, well, Gimme Shelter. We'll put the title up here on the screen when we edit this. So, Ivy, for people that have enjoyed getting to meet you through this video, and who are very much looking forward to having you come back on this program again in the future, but in the interim would like to follow you, learn more about your work, where can they go?
Well, actually, we have access for our portal, just zelmanassociates.com, and free access to our blog and our newsletter. So come join us, log in and get access to our portal. And then other services, you could just email kim@zelmanassociates.com, and hopefully we can provide you some valuable insights. But there are some free aspects to the portal.
Fantastic. Well, Ivy, this has just been a pure joy of a discussion and extremely valuable and insightful. Thank you so much for coming on. And I really do look forward to having you on the program again in the future if you'll come back on.
Thank you, Adam. I appreciate being on. Really have a great day. Appreciate it.
We hope you've enjoyed this discussion with housing expert Ivy Zelman. Ivy was kind enough to provide a free download of the most recent housing bulletin her firm Zelman Associates has published. To get it right now for free, just go to wealthion.com/Ivy or simply click the link provided in the description of this video below. But before you do, please don't forget to support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it if you haven't already. All right, thanks for doing that, and thanks for watching.